We're sitting here in late 2025, and I'm watching the biggest tech companies in America pour $400 billion into AI infrastructure in a single year. That's not a typo. $400. Microsoft, Amazon, Google, Meta, every one of them is locked in a high stakes race to build data centers big enough to cover Manhattan. They're buying chips like there's no tomorrow, signing deals worth hundreds of billions with companies that don't even have revenue yet. And folks, I'm starting to get that same sinking feeling I had back in 1999. You see, I'm 95 years old now, and I've lived through enough market cycles to understand one simple truth. When everyone's stampeding in the same direction, you'd better turn around and check what's chasing them, because more often than not, they're running straight toward a cliff. The AI revolution is real. I won't deny that for a second. But what's happening in the markets right now? That's not investing. That's speculation dressed up in a three-piece suit. And history has a nasty habit of punishing speculation, no matter how smart the people involved think they are. Let me take you back to 1999. I was 1999 déjà vu, sitting in my office in Omaha reading about internet companies with no profits, no products, and sometimes no plans, trading at valuations that would make your head spin. Pets. Com had a sock puppet and a dream. Web Van was going to revolutionize grocery shopping. The Globe. Com, started by two college kids, with 15,000 saw its stock jump 6% on the first day of trading. Never mind that they had zero revenue. And you know what everyone said about me? Warren's lost his touch. He doesn't understand the new economy. The old man from Omaha is finished. I remember one particularly painful dinner party where a young venture capitalist, couldn't have been more than 30, told me I was making the biggest mistake of my career by not investing in internet stocks. He said, and I'll never forget this. Warren, this time is different. The internet changes everything. Well, he was half right. The internet did change everything, but it didn't change the laws of economics. By 2002, the Nasdaq had lost 78% of its value. That young VC, I heard he went back to working at his father's car dealership. Now, fast forward to today. NVIDIA just hit a $5 trillion market cap. $5 trillion for a chip company. OpenAI is valued at $500 billion. That's half a trillion despite posting only $113 billion in projected revenue for 2025. They've committed to spending $300 billion with Oracle over 5 years, which means they'll need to spend $6 billion a year while bringing in $13 billion. Even my 5th grade arithmetic teacher could tell you that math doesn't work. But here's what really concerns me: the circular financing. NVIDIA invests $100 billion in OpenAI. OpenAI turns around and spends that money buying NVIDIA chips. Oracle builds data centers it hasn't finished yet, for money OpenAI hasn't earned yet. This is exactly, and I mean exactly, what we saw in the late 1990s with telecom companies. Back then, companies like Global Crossing and Level 3 Communications were laying fiber optic cable at a breakneck pace. They were lending money to their customers to buy their services. The customers used that money to buy more capacity. Everyone's stock went up. Everyone felt like a genius. 4 years after the bubble burst, 85% to 95% of that fiber was still sitting dark in the ground, completely unused. Corning, the world's largest optical fiber producer, watched its stock crash from 100 to 1. I didn't invest in any of those companies. Not because I'm smart, but because I didn't understand how they were going to make money. My rule has always been simple. If I can't understand it, I won't invest in it. That's what I call my circle of competence. And I've spent 70 years staying inside that circle. You might ask, but Warren, didn't you miss out on the internet boom? Sure did. Amazon, Google, Microsoft, all of them went on to become giants. And you know what? I'm okay with that because for every Amazon that survived, there were hundreds of pets. Comms that didn't. The cemetery of dead. Comm companies is filled with investors who thought they were smarter than everyone else. Here's the thing about bubbles that most people don't understand. They're built on a foundation of truth. The internet was revolutionary. E-commerce did change retail. Cloud computing did transform business. But the question isn't whether the technology is real. It's whether the valuations make sense. In 2000, the Nasdaq reached a price-to-earnings ratio of 200. Read that again, 200 times earnings. Today, we're not quite there yet. The S&P 500's chiller PE ratio is sitting at about 40, approaching the third highest level in 154 years of market history. But here's what worries me. 80% of the market's gains are concentrated in just a handful of technology stocks. The so-called Magnificent Seven: NVIDIA, Apple, Microsoft, Amazon, Alphabet, Meta, and Tesla. They account for 75% of S&P 500 returns. That's not a market. That's a house of cards. And the data just keeps getting more concerning. According to recent research, AI-related capital expenditures now account for more than half of U.S. GDP growth in the first half of 2025. Let me repeat that AI spending is the primary driver of economic growth in America right now. Not consumer spending, not business investment across multiple sectors, one technology trend. I've seen this level of concentration exactly twice before in my life. Once during the Nifty 50 bubble of the early 1970s, when 50 blue-chip stocks traded at absurd valuations and everyone thought they could never go down. Then again in 1999 with tech stocks. Both times ended in tears. The venture capital numbers are even more alarming. Nearly 64% of all U.S. venture capital in the first half of 2025 went to AI companies. For comparison, internet deals only comprised about 25% of VC investment at the peak of the dot boom. We have more than 300 AI startups with valuations over 100 million and 498 AI quote unicorns worth more than $1 billion each. Most of these companies aren't profitable. In fact, 70% of funded AI startups are still losing money, but their valuations keep climbing because everyone's afraid of missing out. You know what we call that in Omaha? Gambling. Charlie Muir, God rest his soul, used to tell me, Warren, it's waiting that helps you as an investor. And a lot of people just can't stand to wait. Charlie understood something that most people on Wall Street never learn. Making money in the stock market is about patience, not activity. Right now, I look at companies spending 22% to 30% of their revenue on capital expenditures, money they're investing in AI infrastructure. That's 3 times what utility companies spend. And utilities actually have predictable cash flows. Meta's planning a data center that would require over 2 gigawatt of power. That's enough electricity to power a small city just to house 1.3 million NVIDIA GPUs. And I have to ask for what? To train AI models that might be obsolete in 2 years to compete in a race where everyone's spending billions to maybe possibly, hopefully, generate returns sometime in the distant future. This isn't investing. This is speculation on steroids. The uncomfortable truth that nobody wants to hear is this. For all this spending to pay off, AI companies need to generate $2 trillion in annual revenue by 2030. Right now, they're bringing in about $20 billion. That's a 100-fold increase in 5 years. Not a 100% increase, a 100-fold increase. I've been in this business since 1951. I've never, and I mean never, seen an industry scale that fast while maintaining profitability. It defies the laws of business gravity. Let me tell, no profits use something about numbers. They're stubborn things. You can dress them up, put lipstick on them, call them adjusted IBID or AI adjusted revenue. But at the end of the day, a business either makes money or it doesn't. And right now, the numbers in AI don't add up. Microsoft, Amazon, Google, and Meta are projected to spend a combined $364 billion in their 2025 fiscal years. These aren't startup companies gambling with venture capital. These are the largest, most profitable corporations in the history of capitalism, and they're spending money like drunken sailors on shore leave. Microsoft just raised its capital expenditure guidance to over $120 billion for 2025. Amazon spending $100 billion. Google bumped its forecast from $75 billion to $85 billion. Meta's at $70 to $72 billion and announced they expect, quote, similarly significant capex dollar growth in 2026. Now, I want you to understand what these numbers mean in real terms. Microsoft's $120 billion in capital spending is 7 times what they spent just 5 years ago. 7 times. That's not growth. That's a complete transformation of their business model. And they're betting the farm that it works. But here's where it gets interesting. Despite all this spending, AI-related revenue remains a tiny fraction of their total business. Microsoft reported that their AI services had reached a $13 billion annual run rate. That sounds impressive until you realize they're spending $120 billion to generate or $13 billion in revenue. That's like spending $9 to make 1. But Warren, you might say this is about the future. They're investing for long-term gains. And you're right, it is about the future. But there's investing for the future, and then there's speculation. The difference is simple. Can you reasonably predict the return on that investment? In the .com era, companies like Global Crossing spent or $15 billion building a worldwide fiber optic network. The logic was impeccable. Internet traffic was doubling every 100 days, so we'd need massive capacity. Except they overbuilt by 99%. When the music stopped, the $15 billion in investment was worth pennies on the dollar. Today's AI infrastructure build-out is happening even faster and at an even larger scale. The parallel isn't just similar, it's practically identical. And here's something that should terrify anyone who understands market history. This spending is being funded increasingly by debt. Meta just arranged $27 billion in off-balance sheet financing. These companies are taking on leverage. At the same time, they're making massive, uncertain bets on technology that might not pay off for years, if ever. I've lived through enough credit cycles to know that debt magnifies everything, both gains and losses. When things are going well, debt makes you rich faster. But when things turn, debt is what kills you. Remember, in my early days, I made the mistake of buying Berkshire Hathaway itself because I was angry at management. It was a cigar, but stock cheap enough that I thought I could get one more puff out of it. That investment, which I made out of emotion rather than reason, probably cost me, or 200 billion in opportunity cost over the years. It's the worst investment decision I ever made. And I've spent decades trying to explain to people why buying a struggling textile company was such a monumental error. The lesson: even smart people make dumb decisions when they let emotion override analysis. And right now, the emotion in AI investing is fear. Fear of missing out. Fear of being left behind. Fear that if you don't invest billions immediately, your company will become irrelevant. That's not a recipe for good capital allocation. That's panic dressed up as strategy. Let me give you some more uncomfortable numbers. OpenAI, the poster child of the AI revolution, is on track to lose several $billion this year, despite ChatGPT's popularity. Despite partnerships with Microsoft, despite a $500 billion valuation, they're hemorrhaging cash. Their costs are so high that they need to continually raise prices while simultaneously trying to reduce the computational expense of their models. And they're not alone. The entire AI startup ecosystem is built on the assumption that eventually, someday, these models will become profitable. But here's what history teaches us. Eventually often never comes. In the dot-com era, we had something called the burn rate, how fast a company was spending its cash reserves. Analysts would calculate how many months of runway a startup had before it ran out of money. Today, we're seeing the same thing with AI companies. The difference is that now they have deeper pockets backing them. So, the burn can continue longer, but the fundamental problem hasn't changed. Spending more than you make is not a sustainable business model. Ray Dalio recently said that he sees bubble conditions forming, but that bubbles don't pop until monetary policy tightens. He's right about that. The Federal Reserve's interest rate policy has been accommodated, making capital cheap and easy to access. But what happens when, not if, but when interest rates need to rise again, or when the economy slows and investors start demanding profits instead of promises? That's when we'll see who's swimming naked, as I like to say. And right now, I suspect there are a lot of naked swimmers in the AI pool. Here's another parallel that keeps me up at night. Market concentration. At the peak of the dot bubble, the top 10 stocks made up about 27% of the S&P 500's total weight. Today, the top 10 stocks represent 39% of the index. That's not just concentration, that's dangerous concentration. If, or more likely, when these stocks correct, they won't just drag down the technology sector, they'll take the entire market with them. Your 401k, your pension fund, your index funds, they're all loaded up with these same companies. The average investor thinks they're diversified because they own an S&P 500 index fund, but they're really making a massive bet on 10 companies, most of which are spending unsustainable amounts on AI infrastructure. And here's the thing that really bothers me. We know how the story ends because we've seen it before. After the dot-com crash, it took the Nasdaq 15 years to get back to its March 2000 peak. An entire generation of investors learned the hard way. The trees don't grow to the sky. But the most concerning aspect isn't the spending, it's the revenue gap. According to recent research, big tech has invested about $560 billion in AI infrastructure over the past 2 years. The combined AI-related revenue from Microsoft, Meta, Tesla, Amazon, and Google, about $35 billion. That's a 16:1 ratio spending to revenue. Now, I'm not a math genius, But I know that you can't spend Wall 16 to make wonders and call it a good business. Some of this spending will pay off eventually, sure, but all of it, not a chance. MIT recently did a study that found 95% of AI pilot projects fail to yield meaningful results. 95%. That's despite more than $4 billion in generative AI investment. The gap between the hype and the reality is wider than the Grand Canyon. What really concerns me is the psychology behind all this spending. It's not based on careful analysis of returns. It's based on fear. Fear that if you don't invest now, you'll be left behind. That's the same psychology that drove the com bubble, the housing bubble, and every other bubble in history. In my 2000 shareholder letter, I wrote about how investors were like Cinderella at the ball. They knew that staying too long would turn everything to pumpkins and mice, but they hated to miss a single minute of the party. Today, we're seeing the exact same behavior, just with artificial intelligence instead of the internet. The party's in full swing right now. The music's playing, the champagne's flowing, and everyone's having a great time. But I've been to enough parties to know that they all end the same way, with someone stuck with the cleanup bill. You know, people often ask me what the don't lose money secret to successful investing is. They expect some complicated formula, some sophisticated algorithm, but the answer is simpler than they think. Don't lose money. That's rule number one. Rule number two is don't forget rule number one. It sounds simplistic, but think about what it really means. If you lose 50% of your money, you need a 100% gain just to get back to even. That's not a game you want to play. And right now, with AI valuations where they are, I see a lot of people playing that exact game. Let me tell you about a study I came across recently. A researcher named Kai Wu examined major capital expenditure cycles throughout history. Railroads in the 1860s, automobiles in the 1900s, radio in the 1900s and 1920s, the internet in the 1990s. You know what he found? In every single case, the companies that aggressively grew their balance sheets through massive capital spending underperformed conservative peers by an average of 8.4% annually. Let me say that again. The aggressive spenders lost to the conservative companies by 8.4% per year over a decade. That difference compounds to a massive underperformance. The patient investor beats the aggressive spender almost every single time. Why does this happen? It's not complicated. When companies race to build capacity, whether it's railroad tracks, fiber optic cables, or AI data centers, they create massive overcapacity. Supply exceeds demand. Prices fall, returns evaporate, and investors are left holding the bag. Right now, we're seeing the exact same pattern. Companies are building AI infrastructure at an unprecedented pace, all betting that demand will be there to justify the investment. But what if it's not? What if AI adoption is slower than everyone thinks? What if newer, more efficient technologies make current investments obsolete? I learned a valuable lesson from my mentor, Ben Graham. He taught me about the margin of safety, the idea that you should only invest when the price is significantly below the intrinsic value, giving you a cushion against mistakes or bad luck. Today's AI valuations have no margin of safety. They assume everything goes right. Perfect execution, continued technological progress, unlimited demand. No competition, no disruption. In my 70 years of investing, I've learned that everything rarely goes right. Usually something goes wrong. Sometimes everything goes wrong. That's why you need a margin of safety. Let me give you a concrete example of what I'm talking about. Cisco Systems was the darling of the COM era, the picks and shovels of the Internet revolution. At its peak in March 2000, Cisco had a market cap of $555 billion, making it briefly the most valuable company in the world. The stock traded at a price-to-sales ratio of 35 and a PE ratio above 200. Everyone said Cisco was different. It had real revenue, real profits, real products. It wasn't some pie-in-the-sky startup. And they were right. Cisco was different. It survived the crash. But the stock, it fell 86% from its peak. Even today, 25 years later, Cisco trades below its 2000 high. Think about that. If you bought Cisco at the top of the market thinking you were investing in a solid, profitable technology leader, you'd still be underwater a quarter century later. That's not even accounting for inflation. Now look at NVIDIA. It's trading at a 500 trillion market cap. Is NVIDIA a good company? Absolutely. Is it revolutionizing computing? Yes. Does it have real revenue and real profits? Yes to both. But is it worth $5 trillion? That's where I have my doubts. For that valuation to make sense, everything has to go perfectly. AI demand has to continue growing exponentially. No competitive threats can emerge. The company has to maintain its pricing power. Technological changes can't obsolete current chip designs. The global economy has to remain strong. That's a lot of things that all have to go right. And in my experience, when you need everything to go right, something usually goes wrong. Charlie Muir used to tell me, all I want to know is where I'm going to die, so I'll never go there. He was talking about avoiding obvious mistakes. And the most obvious mistake in investing is paying too much for an asset, no matter how good that asset is. I could buy the best house in America, but if I pay 10 times what it's worth, it's a bad investment. The same principle applies to stocks. Price matters. Valuation matters. The enthusiasm of the crowd doesn't change the fundamental mathematics of value. Right now, the crowd is very enthusiastic about AI, and I understand why. AI is impressive. It will change the world. But so did the internet, and that didn't prevent the dot crash from wiping out trillions in wealth. Here's something most people don't realize. Even if you're right about the technology, you can still lose money if you pay too much. I was wrong about the internet's impact. It changed the world more than even the optimist predicted. But if you bought the NASDAQ at its peak, you lost money for 15 years. Even though the internet transformed society, being right about the future and making money in the stock market are two different things. The difference is the price you pay. Let me tell you about another historical parallel that's been on my mind. In the 1920s, there was enormous enthusiasm about radio. It was revolutionary technology. For the first time, you could transmit information through the air. Radio stocks soared. Everyone wanted in. RCA, the dominant radio company, saw its stock rise from 85 in 1928 to a peak of 549 in 1929. Then came the crash. By 1932, RCA had fallen to the 18. It took 27 years for RCA to get back to its 1929 high. Radio did change the world. The technology was revolutionary. The early investors were right about the impact, but they paid prices that couldn't be justified by any reasonable projection of earnings. And they paid for that mistake with decades of underperformance. Today, I see the same pattern. Investors are paying extraordinary prices because they believe AI will change everything. They're probably right that AI will change everything. But that doesn't mean current prices make sense. One of the most valuable lessons I've learned is that the stock market is a voting machine in the short term, but a weighing machine in the long term. Right now, the vote is strongly in favor of AI stocks. But eventually the market will weigh these companies, measure their actual earnings, their return on capital, their competitive position. And when that weighing happens, I suspect many current valuations will be found wanting. The other thing that worries me is the game theory problem these companies face. If Microsoft stops spending on AI, they risk falling behind Google. If Google slows down, they risk losing to Amazon. So everyone keeps spending, even though collectively they're probably overbuilding capacity. It's a prisoner's dilemma, and nobody wants to be the first to blink. But someone always blinks eventually. Maybe it's an economic slowdown that forces capital discipline. Maybe it's a new technology that makes current investments obsolete. Maybe it's simply investors demanding profitability instead of growth at any cost. Whatever triggers it, the dynamics will change. And when they do, the stocks that have been bid up to unsustainable levels will come back down to earth. It happened with railroads, radio, electronics, biotechnology, the internet, and it will happen with AI. I don't know when. Nobody does. Anyone who tells you they can time the market is lying to you or to themselves. But I know it will happen because it always happens. Bubbles always pop. Gravity always wins. The question isn't whether there will be a correction. The question is whether you'll be positioned to survive it and perhaps even benefit from it. So where does that leave us? Look, I'm phenylalanine INSIGHT, not saying AI is worthless. I'm not saying these companies won't succeed. What I'm saying is the current valuations embed expectations that are almost impossible to meet. And when you pay prices that require perfection, you're setting yourself up for disappointment. My approach hasn't changed in 70 years, and it won't change now. I invest in businesses I understand at prices that make sense with a margin of safety. Right now, AI stocks meet exactly none of those criteria for me. Can I prove I'm right? Maybe this time really is different. Maybe AI will grow fast enough to justify current valuations. Maybe every one of these massive capital expenditures will generate appropriate returns. It's possible, but I'm 95 years old, and I've heard this time is different more times than I can count. And every single time, it wasn't different. The fundamental laws of economics and human nature don't change just because the technology does. Here's what I know with absolute certainty. If you lose 50% of your money, you need a 100% return to break even. That's mathematics, not opinion. So my first goal is always capital preservation. Right now, the safest thing Berkshire can do is what we're doing, sitting on over $300 billion in cash and short-term securities. People criticize me for not putting that money to work. They say I'm missing opportunities. Maybe I am, but I sleep well at night, knowing that when this market corrects, and it will correct, Berkshire will have the capital to take advantage of the opportunities that emerge. We'll be able to buy wonderful companies at fair prices when others are forced to sell. That's not exciting. It won't get me on CNBC, but it's what has worked for me for 7 decades, and I see no reason to change now. The AI revolution is real. The bubble is also real. Both things can be true at the same time. Your job as an investor is not to predict which AI company will win. Your job is to protect your capital and position yourself to profit regardless of what happens. And right now, the best way to do that is to be patient, be selective, and be willing to sit on cash when you can't find investments that meet your criteria. As I've said before, the stock market is designed to transfer money from the active to the patient. Right now, there's a lot of activity. There's not much patience. I know which side of that equation I want to be on. The AI bubble will burst. I don't know when, and I don't know what will trigger it. But I know it will happen because every bubble in history has burst. And when it does, you'll be glad you listened to an old man from Omaha who's seen this movie before. Stay safe out there. Look, I'll end with outro this. 25 years ago, people called me a dinosaur for not investing in internet stocks. Said I didn't understand the new economy. They said I was too old, too conservative, too stuck in the past. Then the market crashed and Berkshire stock price doubled while the NASDAQ lost 78% of its value. Suddenly, I wasn't a dinosaur anymore. I was a genius. But I didn't change. The market did. The same thing is about to happen with AI right now. I'm the old man who doesn't understand artificial intelligence. The skeptic who's missing the biggest opportunity of the century. The cautious investor who's being left behind. That's fine. I've been called worse. But in a few years, maybe sooner, maybe later, we'll look back at 2025 the same way we look back at 1999. We'll shake our heads and wonder how people paid such crazy prices. We'll marvel at the speculation, the circular financing, the irrational exuberance, and the investors who preserved their capital, who stayed patient, who refused to get caught up in the mania. They'll be the ones positioned to profit from the opportunities that emerge from the wreckage. That's where I plan to be. I hope you'll join me there. Thank you and God bless.